Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for this episode. Joining me is Joe, all the way from beautiful British Columbia. Joe, please go ahead and give yourself an introduction.
Hi, my name is Joe. I'm a father, an electrician, and an investor. I've started investing or at least doing my own portfolio about 2.5 years ago. I had my son, and one of the things I wanted to do was teach my son something that I wish I knew when I was a kid and growing up, and I never knew anything about investing until later in life. So playing a bit of catch up here, but it's been great, and guys like Dave have been really helpful in um, sharing their knowledge and wisdom, and just sharing some stock ideas.
Yeah, thank you for that. And like you said, it's not just me; it's so many of the other guests that have been here on the Passive Income Podcast that share their knowledge. And obviously, we're up to episode 102, and it's just been a wealth of knowledge of people coming on and telling their stories and their paths and their journey. Before we get too much into it, I mentioned you're in beautiful British Columbia. I hope you're very well safe from all the wildfires.
Yeah, so far, but I was in Quesnel a couple years ago. We were on evacuation alert. It was a really scary time, and Prince George is an interference city, so we're right on the edge. I got a big green space behind my house, and if that goes up, there's not a lot of hope. I
Right.
had family that lost their stuff in Fort McMurray and Slave Lake in Alberta, and yeah, it's been good so far.
Yeah, it's very wild what's been happening in Canada with the wildfires over the past few summers. And just quickly, both of my stepbrothers are in Kelowna, and so I've been
Oh
DMing.
no,
Yeah, I've been DMing with one of them. They're safe, everything's good. The one stepbrother, who those 2 are full brothers with each other, and so the
right?
one brother had to evacuate, him and his wife, and actually the wife's parents had to evacuate to my other stepbrother's place. But I just got a message today before leaving work from my one stepbrother saying that their place is still standing, but I don't think they can go back yet. But the good news is the place is still vertical, right?
Yeah, it's devastating, and like what's happening in Hawaii, and it's just devastating. So I pray for them, wish them the best.
Yeah, exactly. Right. Thank you. I'm sure they appreciate that as well. So yeah, let's get into talking about investing and the investing journey and sort of what set you on that path. And like you said, what you want to teach your kids, obviously things you didn't know growing up and that knowledge that you hope to pass on to them.
Yeah, well, one of the things I learned about that really started setting me off down the rabbit hole was the MER fees on mutual funds, and these big banks, how much they're charging. So one of my favorite mutual funds is a Nasdaq index, and the MER on my Nasdaq index that I had through Scotiabank was 1.2%, I believe, something like that. It was over 1%. Whereas you can get an ETF with this exact same basket of the same stocks and pay, I think it's 1/4%. So
Right.
compounding like close to 1%, when you add that in compounding, you can do phenomenally better. Um, I'm a little bit disillusioned with that, and some of the other mutual funds that they really were pushing me into had MERS closer to 2%. And if it's $1 million portfolio, that's $20,000 a year you're paying for them to manage it, when you can get ETFs with similar basket of companies, the exact same risk, and pay a lot less in fees.
Yeah, that's a great point when you just decide to kind of go the do-it-yourselfer route, and you can really save a lot on a lot of fees.
Yeah, the compounding effects of 1% over 30 years, and even if you're into retirement, it's not too late. You can save $10,000, $20,000 if you have a $3 million portfolio in mutual funds. You might be paying 30 to $40,000 a year just in fees, and you can get a very similar index or bonds and build your own portfolio with that's the exact same products, exact same companies, exact same bonds for quite a bit less and save
A
yourself.
fraction of the price, basically.
Yeah. So I that really set me off, and I've just enjoyed researching companies. I've enjoyed learning about how to read quarterly earnings and spot trends and pick up some values. But I'd say primarily I'm mostly in the index funds, and I have I have a bit of a kind of a lot of early people get down too many stocks. So like I'm into too many
Yeah.
different positions. So I'm going through them slowly and seeing which ones I have true convictions in, and which ones I actually think will beat the market. And if I can't beat the market, then an S&P 500 index, or I really like the Nasdaq 100 index. I'd rather just put the money in there and let the winners sort themselves out.
Yeah, that's a great point of being able to do exactly that with an index fund or an ETF. Sort of let the professional money manager just take care of a lot of things for you. And yeah, exactly like you said, or well, you didn't quite say, but you were getting to the point of, these index funds and ETFs, the money managers are gonna, drop the companies that aren't doing great and pick up companies that are doing much better to fill that basket.
Yeah. It's you can get caught up in index funds, like they're trading at a pretty ridiculous multiple. PE, I don't know if it's a great uh, measurement of single companies, but when you spread it across like 100 companies, and historically, like the Nasdaq's trading at around a PE of 31, and now it's 37, getting close to 40, somewhere in there. Uh, it's maybe a bit overpriced right now, but dollar cost averaging into index funds is definitely one of the ways I want to go. And then I want to pick away at the positions that I believe will beat the market over time.
Right.
But at least if I'm wrong about those, and I have the index funds, and if the index funds perform poorly, we're usually all in trouble anyways. So
I think you just made 2 incredible points there in 1 sentence, which was dollar cost average into index funds.
yeah, what a lot of people don't like Dave Ramsey, but one of the things I really like or sorry, not Dave Ramsey, Jim Cramer, and Jim Cramer's wrong a lot. But one of the things Jim Cramer says is your first $10,000 should be invested into an index ETF, and I think that's really good advice. That's a great way to
Right.
get your feet wet without a ton of risk. And there always is risk, but if you hold that index ETF over 10 years, you're not going to lose. Historically speaking, you might lose in the
Right.
short term. It might drop 20-30% next year, but it is also good to
Over 10,
practice
15 years, you're gonna do well.
yeah, so like that's a great way to build a base. And if you like dividends, there's and want to see that dividend snowball, there's lots of great dividend EDFs. A lot of people believe in SCED, and the TSX 60. I think it pays over like 3.5%. So that's the 60
Yeah.
biggest companies in there. So you got the Canadian banks, lots of utilities. I think the railroads are in there, and there's a few growth tech stocks. So it's a fairly good basket. It has underperformed the S&P 500 and Nasdaq 100 historically, but
Right.
those are great ways to get going.
Yeah, you made a great point there. Sorry, I think we just kind of froze on screen
Oh,
for a second. I'm not sure what's going on.
oh, it's all
We'll
good.
just keep we'll just keep plugging along here. Hopefully, we get our video back here shortly. And sorry, that kind of made me lose my train of thought. But we'll see where we go from here. Talking about both uh, the S&P 500 and the Nasdaq, and then also the TSS 60. And
Yeah.
I'm just kind of curious, sort of, is your portfolio more Canadian focused or US focused, or are these index funds based on the TSX, but have you like they're you know what I'm saying?
Yeah.
They're a Canadian ETF or index fund that invests in the US market, or
The
how do you play that, I
Well,
guess,
the
is my question.
TSX 60 is Canadian traded companies, like the kind of the 60 of the biggest and the best of Canada. So like all the major banks are in there. CPCN.
Bell and Talis probably are in there somewhere.
Yeah, I think Constellation Software is in there. So some tech plays, Shopify's in there. It's just a really good basket. It's traded in Canadian dollars, but I'm more focused on the U.S. dollars. I had a little bit of a hometown bias, which a lot of Canadian investors have. Um,
Yeah.
and they get really invested into Canadian stocks and really get really deep into the dividends. And I love dividends, but I love compounders even more. And I like a lot of companies that if they're in the growth phase of their cycle and they're able to reuse their capital to grow their business instead of paying a dividend. I'm only 38. I don't need this money right now. I'm a long-term investor, so I look for companies that will grow the most. And I think some of my most satisfying ones, looking back in 20 years, were the ones I bought now that pay a dividend in 10 years, and it's a steadily growing dividend.
Yeah, for sure. That dividend growth is very nice to see every year when you see a company that gives a dividend raise. That's obviously gives you the warm and fuzzies on the inside, right? It's like, oh, more money. I love it.
Yeah,
But sorry. My initial question there was on the S&P 500 and the Nasdaq ETFs. Do you buy those like through a Canadian company, or are you buying them directly in the US?
I'm buying them in U.S. dollars. So I'm buying QQQ and VOO.
Okay.
Oh, so sorry, the video's lagging here. Sorry,
Yeah,
but
that's
yeah,
okay.
I'm mostly trading in U.S. dollars. My house that I own here in Prince George is in Canadian dollars. My pay is in Canadian dollars. So I am looking to diversify. The TSX 60 I own is in Canadian dollars. I do own both Canadian Railways. So I own them in Canadian dollars. I own EQ Bank, Topicus, Constellation Software as individual ones. So those are in Canadian dollars, but I'd say my portfolio right now sits about 70% US dollars and 30%
Wow.
Canadian. And I'm probably going to bump that US dollar number up a little bit more.
Wow, you are the very first Canadian, person on the Passive Income podcast that has had that much of their portfolio in US dollars, in USD. And I'm not saying there's anything right or wrong about it. That's your approach, and I think it's, if that's what's working for you, that's incredible, that's great, keep doing what you're doing. My question on that is the exchange rate. How do you feel right now with the, I'm not sure, the Canadian dollar is probably at around what, 72 cents per US dollar, somewhere in that range, maybe 74. I'm not a I honestly don't check the exchange rate every single day, but I know the Canadian dollar is kind of low right now. How does that how does that affect your decision making, I guess, when buying US stocks?
It's tough, and we don't know where the world reserve currency is going. You hear talks on FinTwit of like the BRICS currency taking over, but China. There's so much geopolitical risk in there. It's tough and almost uninvestable. But there is some good international Canadian companies for sure.
Yep.
But the world and they're all trades dollars. And I'm just looking at it is the best option right now. One of the ways to get away around from these fees is to use a dual listed company. So um, when I first started buying, I was really heavy into TD. So I had over 15% of my profile in TD, and I did not feel quite comfortable. TD is a great company, but
Toronto
the TD is
Dominion
dual
Bank.
listed. so you can do what's called Norbert's Gambit, and you can move it your shares in Canadian dollars, and you could trade the exchange share for share to US dollars, and then you could sell it there and buy stuff in US dollars without paying a high exchange fee.
That's
So
interesting.
that's one option that not a lot of people know about. But yeah, you never know what the future is going to hold. But historically, the U.S. stock market has outperformed the Canadian stock market,
Right.
and I think that like there's some great Canadian companies, and I do like the TSX 60. I think it is a good index ETF, but I have a little bit stronger conviction in the U.S. Companies, especially I really like Microsoft, Apple, Amazon, Costco's in the QQQ. There's
Right.
just 100 really solid companies that have the up and to the right charts on
Yeah.
their on their incomes, on their all their key performance indicators. Uh, so I really like them, and there's some stuff that might be really overvalued. Nvidia is trading at a ridiculous multiple. Everything has to go perfect for a very long time for that valuation to work out for a lot of investors. And then you have some stuff like PayPal, like maybe their moat's weakening on the QQQ, but if if if, uh, if the market was wrong about pricing QQQ, I own it. If the Nvidia falls, I have other ones to to rest on. And some of these companies are so big, like Microsoft just acquired Activision Blizzard. I'm not sure if it's 100% finalized, but they're one of the companies on the 100 QQQ 100 is getting swallowed by one at the top, and that's a 70 some billion-dollar deal. Like
Right.
they're just behemoths, and they're so wide, they're so diverse, they're so international in their scope. I don't see them going anywhere, and I can see them dropping in 30% next year. But in 10 years, I see that index being a lot higher than it is today.
Interesting. You quickly mentioned the acronym BRICS, which, correct me if I'm wrong, is Brazil, Russia, India, China, and I think the S is Saudi Arabia, if I'm not mistaken.
Yeah, I think so too. And I haven't dug down that rabbit hole, but a lot of these countries are getting a little bit tired of trading in US dollars and want to bypass them. So, and Ray Dalio says the world reserve currency changes every 100 years. So could it be the BRICS currency is the next world currency we do trading in? It's impossible to predict. It
Yeah,
really is.
none of us know the future, obviously, and
Yeah,
I think that is a very interesting dynamic with those countries. Like I mentioned, Brazil, Russia, India, China, and Saudi Arabia. And the comparison to the G7 nations of 20 years ago, the BRICS countries had such a minor percentage of global market other than China, obviously, and now they're as big or bigger than the G7 nations.
yeah, they have a huge population. They have like Russia has an incredible amount of resources. China has an incredible amount of manufacturing. I think India is becoming a really big player. I know iPhone just started production of their iPhone in India. So it'll be interesting to see these how these emerging markets play out.
Right. Yeah, no, I agree 110% on that. It's going to be very interesting to see what happens, and like you said, very interesting to see if the world reserve currency does change, or does you know drift away or guide itself away from US dollars.
Even if it does, I see a lot of those companies. They're big international behemoths. They'll whatever they're trading in, whether it's it's Bitcoin or U.S. dollars, they're going to get their
Yeah.
shares and
Yeah, exactly, right.
of the profits, and they're not going anywhere. And Western society may not be the biggest, but I still believe in, at least in my lifetime, that we'll still be big players. Europe will still be a big player. North
For
America
sure.
will still be a big player, and even if we trade more in BRICS currency, um, I think Canada will be okay too in the long run.
Yeah, I agree with that sentiment as well. Obviously, North America, Europe are going to still be huge trading partners and players in the global economy. But yeah, basically, like we've just mentioned, who knows where this where the BRICS, those countries of the BRICS, will end up, or how it's going to go. Because as you and I seem to agree, we can't predict the future. We don't know.
No, and that's one of the things like I like about Peter Lynch. He said he's like if if you spend 20 minutes on economics, you wasted 13 minutes or something like that. So as investors, it's like we got to look at the companies individually. We got to look at their balance sheets, where they're going, and a lot of us like Graham Stefan on YouTube, or like New Money, and all these guys
Yeah,
doing a lot of the macroeconomic picture, and I love that stuff. But as an investor, it really has little to no impact on my results for most of the companies I own, and it's
right.
just a lot of noise. And as much as we enjoy talking about it, you got to concentrate on your fundamentals and your convictions, and it's if the fundamentals of the business hasn't changed and they're getting stronger, then the rest of it's all just noise, right?
Yeah, exactly, exactly. I do have a question, kind of moving forward through this. Obviously, you're heavy into like ETFs and dividends, and that is incredible because, like you said, or you mentioned Jim Cramer saying like having the first 10 grand just in ETFs and index funds, and make it as easy as possible on yourself for that first uh, amount of money. What individual companies are in your portfolio that that kind of really get you excited, or something that maybe something that's your biggest position as an individual company? Are they Canadian? Are they American? Is it something like Bell Canada or something like Starbucks? I'm just throwing out a couple names there.
It's I really like EQ Bank. I think that they're they got a really great balance sheet. And one of the things I learned early in investing is like banks' balance sheets are really hard to read. And
Right.
to like you see like the loan loss provisions, you see bond yields, you see all this stuff, and they're a lot of the Canadian banks are really tied to mortgages, and as much as we have to
Yeah.
ignore macro for a lot of businesses, for banks we have to consider macro. I think a lot of Canadians will be in trouble. I think our real estate is up for a correction. Um, but like we lock in for 5 years at a time. In the States, like you lock in for 30 years. So all those
Yeah.
people in the States that might have paid a bit too much and locked in for 30 years at 2.5%, they don't really care because they have an affordable payment for the next 30 years. It's like they might not be able to sell or move, but they have an affordable payment. Here in Canada, when the 5% is up, some of the markets in well, Ontario, I don't know if it's where you're at, but like Toronto, you see the average home prices have far out exceeded incomes. Vancouver,
Oh yeah.
Kelowna are the same way. Um, so I think the banks do have a little bit of risk coming up. I don't think the banks will get hurt because you have CMHC insurance. So a lot of these people that are upside down had CMHC insured mortgages. So the banks will get their money either way, even if the taxpayers bailing them out. EQ Bank's a newer one, and they mostly just do like online savings, so they have a lot less risk. And I think their business model being more online and having more call centers and less branches, that's less infrastructure. They're a little bit lighter, a little bit more maneuverable. I really like that stock. I like the railroads, CPCN. I can't think of a business with a better moat. Uh,
No, there
being
isn't. There really isn't. Nobody's building another railroad tomorrow.
No, and you'd have to build them parallel to those lines. So I don't know how it would work, and the environmental regulations, and buying that much property. The KPIs are a little bit down, but so maybe that one might come up on sale a little bit here. But yeah, there's just such a big moat, and they're not going anywhere. We haven't developed any way to transport goods that's better than the rails. Long haul trucking is a lot more price per ton.
For sure.
Um, I really like Constellation Software. They're way up. They're up like 18,000% over the last 10 years. Um,
That's
but
unreal.
but they just keep compounding, and they keep acquiring all these sticky SaaS companies, so the vertical software
Mhm.
for industry. So they're almost like an ETF of themselves, of all these really good sticky software solutions. And I don't see software going anywhere because it's replacing a lot of jobs, making a lot of jobs easier, making logistics, making everything way more efficient. And they just did a deal where they're only paying 20% cash now. It's vendor financed over the next 40 years, and they got this mortgage software company um, that sold for like $2 billion a few years ago for like $250 million or something like that. So even though they're growing, they keep doing these amazing deals. They have an
Right.
incredible founder. He's oh, what's his name? But anyways, he still has a lot of ownership. He's one of the best CEOs in the business. So if you look for companies like that, and don't be afraid to jump on these companies that'll keep compounding. One of my favorite dividends ones is Costco, and its yield is only 1 point, um, low ones percentage, but they
Right.
grow 10% year over year, and the equity in the stock keeps going up. It's up 74% over the last 5 years, and it's a little bit pricey, but all the good ones are. It's like we spend so long looking for deals when it might be better off just to buy one high quality one, pay a little bit of a high price. And
A premium, pay that premium, but, you sort of in the mindset of you get what you pay for?
yeah, and buy once, cry once, and just hold on to it for 10 years. And it's like, oh, well, I might overpaid a little bit, but in 10 years does it really even matter?
Yeah, exactly. I have, I have kinda 2 follow-up questions to everything you just said,
Yep.
and the first is, do you follow Anthony on X, the app formerly known as Twitter? His, handle is @newcomerinvestor.
No, I should. I'll definitely look him up.
Yeah, because basically everything that you just said about EQ Bank and the rails, he is on that all the time. And then the follow-up to that, and this is because of Anthony, what are your thoughts on Brookfield?
Oh, Brookfield. Brookfield owns a lot of good assets, and yeah, I do like Brookfield. I think they're one of the few things that are kind of undervalued a little bit right now. They own a lot of great assets. The Brookfield Infrastructure Partners I really like. I don't own Brookfield Infrastructure Partners, but I like BAM, and I like Brookfield National. I do own those. I don't know.
It's
I
honestly, it's
assume
like it's talking to Anthony, man. It's like
he probably got a lot of those from the Canadian Investor podcast too.
I maybe
So
I'm not sure. I'm not sure where he's a great young person. He
yep,
calls himself newcomer because he's somewhat new to Canada. He was born and raised in Europe, and he's been in Canada. I'm not sure 5 or 10 years now, but he's a very knowledgeable investor. But
yep.
so many of everything you just mentioned, like I said, EQ Bank, the railroads, Brookfield, he's all over those companies, and yeah, I'll definitely send you his handle in a DM, and definitely make sure to give him a follow, and I'll make sure he follows you as well.
Okay, thanks. I appreciate that.
Nice, nice. That sort of made me lose my train of thought again a little bit, but I had to get that in there just because, like I said, it was everything you've been saying is so similar to everything he's been saying to me over the last 6, 8, 12 months as well.
Right. Yeah, and like you like REITs. I do own Granite, and I own Equinix. which
right?
is that's an American one that's and it has it's always pricey, but it has the record for the most consecutive quarterly earnings, like increasing quarterly earnings at it's I think it's at 80 quarters, so it has 20 years of consecutive um, profit increases, and
Right.
it pays a low yield right now because it's expensive, but it's a data center, so they own all the data centers, or a lot of data centers in the states, and data is not going anywhere. They don't like have the servers; they just supply the refrigerated space. So it's a really incredible business. It keeps growing, and I own Granite. I like industrial real estate.
Yeah.
Commercial real estate, I don't know where this work from home is going to go from, and I know there's a lot of office REITs that have been really hit hard.
Oh,
Uh,
I know. I've
yeah,
been hammered this year with office REITs.
they've been definitely hitting value territory. But yeah, I do like real estate, and like Costco owns 47 million square feet of warehouse space.
Yeah.
McDonald's owns 47,000 acres. Uh, so real estate is a great business
Yeah.
to be in, and yeah, real estate's really interesting. I read an article that it takes around 7 years from the time you get a permit to to break the ground, to tear down the old buildings, to build a skyscraper. And over 7 years, the economic landscape changes a lot. And it's why a lot of these huge new buildings that get built transfer ownership 2 years after opening.
Right.
It's kind of actually an incredible stat, and it's so tough to get 70 stories put up, and when you do, who knows what kind of economic landscape. But if you can have a company that buys the land, puts a proven business there, pays it off, and makes money the whole time, like those are phenomenal businesses to buy.
Like Costco and McDonald's and like,
Yeah. And
the
Costco now they're starting to build some apartment buildings on some of their on top of some of their warehouses, or
yeah.
beside them, and have parking structures, and that's another growth lever that Costco can pull in the future, and
Well,
that's
didn't they do that a long time ago in downtown Vancouver, like, right across from the stadiums? Is that Pacific Boulevard across from the stadiums, and there's, like, that underground Costco, and
yeah.
then above ground is, like, whatever it must be, like, it's downtown Vancouver, there's gotta be, like, condos and whatnot all above it, so I don't know if Costco owns that property or what, but just as you were talking about Costco putting up, um residential spaces on their land, it just immediately made me think of that, downtown Vancouver location.
It's a little bit speculative on my part right now, but that's like another growth lever they can pull, and you see them in like some of these major Canadian cities, like how fast they're growing. Like, I'm originally from Edmonton. Some of the Costco stores, I'm like, well, that's actually fairly central to Edmonton now, just based on how much it's grown over the last
Right.
30 years since that store was built. So uh, I,
Yeah, where 30 years ago, it might have been sort of on the outskirts or almost the suburbs or whatever, but, yeah, cities grow and the suburbs and the outskirts get swallowed up, and suddenly it's part of the I don't wanna say inner city, but part of the city, like, the proper city proper, right?
yeah, and another thing about Costco I really like is when the founder, when he started that company, he's like, he thought of the customers he didn't want in his store, and that's really paying off in today. So Target this year will have 1.8 billion dollars in shoplifting. That's
Right.
1.8 billion dollars of goods right
Loss.
out the door. That affects the investor's bottom line. And the way
Yeah.
Costco does it with the memberships, where you single file entry in, single file entry out, with the checking of the goods, their theft has increased very negligible.
Yeah, yeah.
So that's
And
one of the good things about them as a retailer. You look at Target; they've had to close down 4 stores in Portland
Yeah, and Walmart's
because
in
of
that same
theft.
problem with the self-checkout, right? Like, so many people in self-checkout are like, "Scan one, skip one, scan one, skip one," and
Yeah. And it's a major problem for retailers, and that's one thing Amazon doesn't have either. And I do like Amazon a lot, and I do own them a little bit individually, but I wonder why, because the ETFs are so heavy in them that I own. So
Right.
I do have a lot of overlap that I will have to go through on my portfolio, but luckily I haven't made too many mistakes. So
Yeah, that's good. That's good. And a little bit of overlap, especially when you have like several ETFs and then you start buying individual stocks, overlap is going to happen. I have it myself with like some Canadian bank ETFs and then individual stocks in the Canadian banks. Basically, it's just going to happen. I honestly I don't lose any sleep over it. It doesn't bother me at all.
yeah, yeah, and I think you do have to keep a little bit of an eye on it, especially if like, okay, well, this ETF is 10% that company, this ETF's 10% that company, and I own 5%. It's like, wow, that's 25% of my portfolio, and
Right.
I don't believe in like you can have whatever concentration helps you sleep at night. There's a lot of investors that have bought very few companies, and like lots of the super investors make very few moves. Warren Buffett doesn't make very many moves. He sits on cash and waits for opportunities, and just lets time sort it out.
Yeah.
So if you have a really strong conviction, I'm definitely not going to sell off my winners, like take profits. Unless the business fundamentals change. If it's way up and the business fundamentals are still great, and I still see that company as a wide moat. I still see them raising dividends or increasing my equity. I'm just going to leave them alone and let my winners run.
Yeah. I I can't fault you for that at all. Like, yeah, why wouldn't you let your winners run, right? Like just it's like nobody told Secretariat to stop, right? So just
Yeah,
let those winners run.
yeah. So like I'm not in any small caps or like medium caps yet, but if like that's where you're going to find the hunter baggers, and they're hard to find. They're a little bit risky, but if you have a hunter bagger that turns into a behemoth of a business and it keeps going up, it's like I'm not gonna take profits, and it's like
Right.
like eventually some of those companies will get to the point of dividend payers, and I think a lot of people don't look for dividend initiators enough. So it's like, okay, these companies are very profitable. They've grown, and they're going to over the next 5 to 10 years, probably be in as position to initiate a dividend. And it might be a very low yield, but if you go from zero dividend to say 1%, and then that 1% grows 10% year over year, that's going to compound maybe a little bit better than some of the ones that are already paying 4%.
Yeah,
Uh,
that's a great point, and honestly, 102 episodes in, you are the first person to use the term dividend initiator, and I love it. It's a great concept, a great idea to be and of course, we all know looking for these, like you said, 100 baggers, they feel like they're near impossible to find. And you really have to do a lot of research and a lot of digging and a lot of knowing, everything about a company to have that conviction to say, "Hey, this company is trading way below its maybe it's at its current valuation, but like you in 5, 10 years, it could, you know, whether it's a 4x, a 10x, a 20x, a 50x, or a 100x, and then all of a sudden you become a dividend initiator." I love that term. That's incredible. I love it.
yeah, and there's lots like Amazon is like such a big company, and they'll get to a point where they can't invest any of their excess capital, and they will probably initiate a dividend.
Right.
And I think a lot of dividend investors get in the rabbit hole of just looking for companies that pay dividends,
Yep.
and like especially some of like your younger listeners and younger people. It's like, no, you should be concentrating a little bit more on growth. If you're say in your late 50s or 60s and you need that income, I it'll be fairly easy to find great companies that pay a strong yield going into retirement.
Yep.
But 20s, 30s, 40s, even 50s, if you want to work till your 60s, it's like I'd be more growth focused and then slowly throttle back that as you get closer to retirement and build your nest egg. Um, and yeah, the 100x companies. Peter Lynch is one of my favorite investors, but he'd spend 80 hours a week in the office, digging through all these earnings, all these things. He'd buy an incredible amount of stocks, and I am not. I don't think that's for me. I work full time. I'm a father on the weekends. I want to be present in my kids' life. I like hitting the gym. And that's one of the things I like in index ETFs. And I'd like to get my portfolio position down to maybe 15. And then
Yeah,
that's 15 quarterly earnings I got to read. That's 15 businesses I got to keep an eye on, and that's a lot more manageable time wise. And I'm just looking for great compounders, and I'm not trying to get the 100x's. Like, it'd be nice if I could dig through the needle
yeah.
pile to find those, but if I can double my money every 7 years and maybe beat the S&P 500 index a little bit, I'd be very happy.
Yeah, I think that's a great point. I just quickly go back to REITs, and I just need to get your thoughts on RioCan simply because everyone knows it's one of my favorites.
Yep.
And so just your thoughts there. Obviously, we've talked about commercial REITs and um, just go on RioCan. What are your thoughts?
I don't know much about that name. I can't really comment on that. Canadian Investor Podcast, Simone Bilager. I probably butchering his name, but he did a deep dive on Allied property. So is RioCan, is it like a commercial REIT, or what kind of businesses do they own? Do they own?
Yeah, so they have quite a mix. They have a lot of retail space, and then they do also have some office space, and they are
Okay,
trying to build residential space as well. But as you mentioned, it takes a long time to get through actually building more buildings. So um, they really want to increase their residential space over the next 5 to 10 years, or potentially 15 years. But as of right now, I would say probably I would have to go back and look, but it's, primarily focused on the retail space. The one that I'm most familiar with is in Kingston, Ontario, where the anchor store is a Home Depot, and they have, there's like a movie theater, there's so many retail stores, there's Best Buys, there's, Canadian bank locations, there's restaurants, like, it's probably the size of 3 football fields. It's a fairly
right.
large, retail complex.
I do know they're definitely unloved, and there could be some opportunity there. Retail, yeah, I'm not sure which way it's going to go, and especially like office space. I know a lot of Canadian investors are in Allied properties. It's down right now. Simon Belanger, he did an incredible coverage on that on the Canadian Investor podcast. If you want to dig through that one,
Right.
so I think there's some value. Like these a lot of these REITs are just so hated right now, and I
Well,
believe
they're
they're.
getting hit hard with the interest rate, increases, right?
Yeah, and so you'd have to look at the debt and the tenancy, and I think this one's going to be a little bit drawn out too, because a lot of these tenancies are 5 years, and especially in the office space, it's like, okay, well, our 5 year lease is coming up. Half our employees are doing hybrid, working from home. It's like, do we need this big office space? Are we going to downsize? Are we going to renegotiate because of like vacancies in Vancouver? And I've known Calgary's gone through a lot of really big cycles of boom bust of office space real estate. I don't know what the future of that is, and I think there's a lot of uncertainty in that space. So that's going to be a pass for me. And there's probably going to be some investors that are going to make a ton of money
Yeah.
grabbing up some great values that they have a lot of conviction in. But I don't think that they're going to be for me, those REITs.
Just my final thought on RioCan, 9 cents per share per month in dividends. So it's a nice monthly payer of dividends, and right now it's a fairly juicy yield because it is trading. Well, everything is kind of hammered and down right now. It's below $20. dollars a share, so I'm not exactly sure what the yield works. It's pretty nice right now, and even though it's the biggest position in my portfolio and way too large percentage wise, I still see it below $20, and I really have a hard time not just buying 5 more shares every now and then.
Yeah, and if that's your conviction too, and like it could be an incredible buying opportunity. I bought Facebook when they were at 170. I didn't hit them at the bottom when they hit 90, but even at 170, they had 20 cents of cash, no debt on hand. And then when they were down to 90 bucks, it was screaming at me to buy more, and I should have followed my gut a little bit more. When they were at 90 bucks, they had 40 cents of cash,
Right,
like for what they were valued, like for every dollar of share. And a company like that has incredible free cash flow, incredible network effects. They got 3 billion monthly users, or daily users, and like 4 billion monthly users. And
that's half the planet.
it's half the planet is on that. That's the biggest network effects probably in the world. WhatsApp is the most used app in the world, and they're finally starting to monetize WhatsApp, especially in emerging nations. It's used so much for commerce, and it's just there's such a behemoth. Instagram they bought for $1 billion, and it does $1 billion in revenue like every 20 days or something like that, and they only paid
Right.
$1 billion for it. Same thing with Google. They bought YouTube for an incredible price. And YouTube,
Yep.
me and you talk here for 45 minutes. Google pays nothing to us unless a lot of people watch us, and then they get revenue and they share the revenue with the winners, and lose it.
Yep.
And then that's one of the great businesses Google owns. Google's about 6 different businesses. It's not just the search engine. Microsoft is like 6 different businesses. Amazon is 6 different businesses. They all have their web services. And if you look at the NASDAQ 100, it's probably closer to 250 businesses, even though it's 100 listings. There's just so many great businesses in those spaces. I think uh, Facebook is about $60 of revenue per North American user per year in advertisement dollars. Like that's a lot of money.
Right.
And yeah, they're like I have 20 years of or not 20 years. I've been on there since 2007. I myself have 16 years of my life on Facebook. Like pictures, memories, and stuff. I'm not leaving it. Like that's a huge. They got an
Yep.
ingrained customer probably for life now.
Yeah. That's a great point about Google owning YouTube and sharing some of that ad revenue, which just makes me want to say subscribe, please
Yeah, and smash
subscribe.
that like button. I should have said that earlier. That's one thing Graham Stefan does. It's like smash that like button for the YouTube algorithm. So
Yeah,
like the
appreciate
best
that.
holders.
I feel like we could keep talking forever because I want to ask you about like. Well, I'm gonna do it. We're gonna end up going here another 10 or 15 minutes, and we're gonna end up being over an hour, but that's okay.
Yep.
Um, Canadian telecoms, Bell, Telus, Rogers, and that new merger. Well, the acquisition was Rogers acquiring Shaw, but Shaw had to sell Freedom Mobile to Quebecer, if I'm not mistaken.
Yep.
So, just kind of your whole take on the Canadian telecoms.
The Canadian telecoms, the one thing I don't like about telecom businesses is they're so capital intensive, and you have to
Yeah,
keep.
a lot of debt, a lot of
Yeah.
infrastructure.
And the one thing I looked into Telus a little bit because Bell, I don't like the media side of the business. Telus,
Right.
I did a bit of a dive into. One of the things I don't like about Telus is their shareholder dilution. So a lot of
Okay.
people got their caught with their pants down with Algonquin, and
Yeah.
Algonquin had a lot of shareholder dilution. So if I'm a Telus shareholder and I've been dripping since 2020 with the shareholder expansion, um, I if I dripped my dividend and bought new shares every month for a year, I own the same percentage of the company I did in 2020 because they issued a lot more shares. So the shareholder dilution of Telus I didn't like, um, and I lived rural for a while, And one of the things out there is we didn't have reliable internet service, and a lot of people got Starlink, and they just
Right.
loved it. It was super fast, super reliable, way better than all the other ones. And like Telus in my neighborhood here, they like it's all underground services to the houses. So they had to do
Mhm.
all this underground service to get fiber to my house, and had crews out here for months and months and months and months to get fiber to my house. And I lived in a camper trailer for a summer while I was moving from Quesnel to Prince George, and I was using my cell phone to stream, and like I had to cut back a little bit. I did some downloads at coffee shops to download some movies or whatever to because you can store Netflix on your devices. And I'm like, do I really need home internet anymore? And I see the cable cutting trend. I wonder if the home internet will become a trend in going into the future. And I don't know how the work from home like that may benefit their residential, but I wonder about their commercial businesses and with offices not needing like so many desks and so many hookups, how that's going to affect Telus's commercial side going forward. So I see a few risks. I and I think they're priced in maybe, but for me, I like to own businesses that don't have uh, trends. I like to see the trends going the other way, and I like to see a bit better balance sheet. I don't like a lot of debt, and for me, Telus was a no. And I didn't look into Bell. I didn't like the media part of their business, and I haven't looked into Rogers, so I can't speak on those ones.
Yeah, fair enough, and I can't agree more about, the massive amounts of debt that Bell and Telus, and I'm sure Rogers also, 'cause I'm the same, I haven't looked into Rogers as much either, but, like, quite honestly, last I think it was January, Bell announced a dividend increase, and part of me was excited, I'm like, "Oh, hey, yay, great, I'm gonna get more in dividends," but at the same time, I'm like, "I kinda wish you didn't raise it and started paying down some debt." And it's just it's massive debt that those companies carry because of the capital expenditures that they need for improving infrastructure. Exactly to your point of whether it's digging up streets or anything underground that's the fiber optics and the cable and everything that goes into maintaining that network is just it's phenomenal. But sort of the reason I ask you that is because both Bell and Telus are right now trading at, well, Telus is definitely at a 52-week low, and Bell is either near or at a 52-week
Mhm.
low as well. So as of right now, they look like very uh, juicy buys because we know those companies aren't going away. They're right. They're in Canada. They're the number one and number two um, telephone, whether it's land, they still use landlines and offices
Yeah.
and whatnot, but obviously their main revenue is probably cellular at this point, and we know that they're not going away anytime soon. So
Oh
that was just sort of my reasoning for asking you about the telecoms.
no, and I definitely like their wireless business. Like wireless is the way of the future. It's but Canada, we're just so spread out, and like I live in rural BC, Prince George, so it's a city, but the surrounding areas to get all these cell phones and all these fibers to like when people have
Yeah,
5 acre lots, it's an incredible amount of infrastructure. And Canadians, we always complain about how much our cell phone bill is. I'm an electrician, so I know how hard it is to get wires everywhere. And
yeah,
you know what? I don't ever complain about my cell phone bill with the amount of infrastructure they have to do. But and they're hammered. It may be at value, but I just can't do it. And I see it as a bit of a yield trap. And if interest rates go up, is that dividend safe? I don't think that dividend will ever go away, but is that dividend going to be reduced? And like you said,
it
it's like, oh, I
it
wish
could
I
have
wish
get
they paid
cut.
off more
Yeah,
debt. And if I was a TELUS shareholder, it's like, well, I wish they weren't paying as high a dividend and diluting me, because shareholder
right.
dilution is one of the metrics I look for. And I sold out of Algonquin at I think $18 when, again, Canadian Investor Podcast. Shout out to Simon and Braden. Um, Braden pointed out how much shareholders were getting diluted to fund their renewable energy projects, and they could have been issuing
Right.
green bonds locked in at 3% because everybody's was wanting to buy green bonds and green energy, and instead they decided to dilute shareholders by issuing new stock, and then all of a sudden they had to cut their dividend in half, and um, that they, it's I think there's some risk in that business, and I don't like businesses that have to reinvest so much capital just to maintain their business. So that was a pass for me. You look at AT&T too in the states, like the same things happening with the telecom industry there, and I could see Starlink, like if they come out with a mobile device that everybody likes and it works great and has incredible speed and data, then where does that leave a company like Telus with all these wires in the ground that aren't quite paid for yet?
Right. That's a great point. And I was actually going to kind of ask you about Algonquin Power, so you sort of answered to that question without me having to ask because same thing. That dividend cut hurt a lot.
Yeah,
Hurt, right?
it hurt a lot of people.
Personally, it hurt me.
Yeah. Um, yeah, so that one Braden Dennis pointed out to me, and the way it was sold to me is like, oh, it's a safe Canadian dividend payer, utility. Uh, okay, so okay, they have a good yield. Okay, I forget what you.
And honestly, I still feel it's a safe investment.
Oh
I
yeah,
like Algonquin Power isn't going away anytime soon. They're still going to be around in 15, 20, 30 years. And, I've said this in the past on past episodes where you're gonna look back at, that cut in when was it, 2022 or early
yeah.
2023? I think it was January 2023, and we're gonna look back on that and not even really remember it because whether it's 10, 15, 20 years down the road, Algonquin Power is still gonna be a very strong player in the Canadian, utilities sector, right?
Oh yeah, yeah. And we still need power. We still definitely do need it. But just to be aware of when these yields start creeping up and these companies start looking really juicy, we have to be very careful. Is that a falling knife, or is that a yield trap? And we have to really dig deep into why these companies decline in value. And I think Algonquin's definitely trading at a fair price, but it like that one hurt a lot of people, and especially if you're into
Yeah.
retirement and you're relying on that for your income. You have to be really really sure of the companies, and shareholder dilution and debt is for all these infrastructure intensive businesses. We have to keep an eye on those metrics as investors.
Yeah, exactly, and honestly, when they cut their dividend, obviously the share price, dropped, like, nearly in half. It went from, like you said, around that 17, $18 mark to below 10, and I think it might have even been below, uh, 9 at some point, Canadian dollars, obviously, and I'm still kicking myself for not picking up more when it was down at in the $8 to $9 range, and
Yeah,
I still haven't picked up any more, and I'm still looking at it going, 11, $12, that looks pretty good, right? And,
yeah.
but I've just been allocating my money elsewhere, as of right now, like accumulating it in other things. But I still keep looking at it going, it's tempting. It's very tempting.
Well, when there's blood in the streets, right? Like if
Yeah,
that's a strong conviction of yours and it's on sale, then buy it and do it. And that's one of the great things. Like I'm about index ETFs is I have half my money in there. So if I do make a couple mistakes on individual stocks, or then at least my money overall is safe. And if
yeah,
the S&P 500 goes down 20%, then chances are the TSX it never goes down. It seems as much. It's not as volatile, but it's going to go down a little bit. If the whole economy goes down, every stock price goes down, right?
yeah.
But yeah, at least I have that money tucked away in a float, and it'll let the winners choose themselves. I'm paying a lot less fees now, and I think I'll I'll do well in those investments, and anything else that I pick, I'm gonna have a really strong conviction that it will outperform. Um, and if not, then I'm just gonna put my money into the indexes and call it a day and go for
Yeah.
walk my dog or whatever.
Nice. Wow, I can't believe we've been talking for an hour already. I'm gonna quickly, pull up your Twitter, sorry, X. Is it X? Is it
X
Twitter?
account, yeah, there we go.
And your handle is, correct me if I'm saying this, not, right, but at Sallis_Joe?
Yeah, yeah. I never really when I did this page, it was probably 10 years ago, and then I just got back into Twitter a couple of years ago because some of my a lot of podcasters say to follow them on Twitter, and yeah,
Right.
Twitter's one of my favorite social media companies. Like I follow positive guys like you and investors like you, and uh, it's highly intellectual, and none of my friends really do investing. Or well, I have a couple that do, but most don't. Most
Yeah.
are tradesmen that spend every dime of their paychecks. So it's nice to find some like minds, um, and I'd love to start creating some content and some of my thoughts. I like posting those. And it's great to share with like minds and get advice.
Yeah, exactly. That's great. I definitely give Joe a follow. You can find him on X at Sallis_Joe. And exactly like you said, finding like-minded people that, on in a social media platform like Twitter/X, where we can discuss things and follow each other and have just incredible conversations about investing, about dividends, about passive income, about total return, about growth, what like so many great people. And yeah, it's you're definitely worth the click on the follow button. I can say that for
Thank
sure.
you.
And with that said, like I said, we're already well over an hour now. I feel like we could talk for like literally just hours on end at this point. We could, but
Yeah, it's all good.
um,
I'll let you go. But before you leave, smash that like button, smash that follow button, and uh,
thank you.
yeah, I'll
I was
definitely
just gonna
share this on my socials. So hopefully we can build up your channel a bit here.
Awesome. I appreciate that so much. With that said, thank you so much for your time. I truly appreciate having you here on the Passive Income Podcast. Again, this has been an absolutely incredible conversation. I really appreciate you and your time. And thank you so much for being here. With that said, if you are still here over an hour later, the rules are subscribe.